Start. Tēnā koutou, kua huhui mai nei, ko Mark Fink toku ingoa. I'm an Assistant Secretary here at the New Zealand Treasury, and it is a real pleasure to welcome you to this Treasury guest lecture this morning. And I'd like to particularly warmly welcome Carolin Nerlich, guest speaker, joining us from Frankfurt, and beautiful background there. Carolin was just explaining to me that is the building she's sitting in behind her, the ECB headquarters in her photo. Just a couple of words about the Treasury Guest Lecture series. As will be familiar to many of you by now, our current theme explores the role of stabilising sustainable and effective fiscal policy. We chose this theme because of the important role that fiscal policy has in contributing to the living standards of New Zealanders. Our speakers in this series have been providing insights into how fiscal policy can be designed to support government to meet its current and future obligations, while adapting to changing circumstances and delivering value to the New Zealand public. And this theme aligns with the fiscal focus of the 3 stewardship reports that the Treasury has been publishing over the course of 2025. The first one was released in August when we published the final long-term insights briefing on sustainable and resilient policy over the economic cycle. The second was released in September when we launched our long-term fiscal statement, which explores the economic, demographic and environmental factors that are most likely to shape New Zealand's fiscal future over the next 40 years. And finally, actually this week on Friday, we will release our latest investment statement. And this provides a comprehensive overview of the government's balance sheet, its performance, and how public assets and liabilities are being managed to support public finances now and into the future. And I encourage you to look out for that. Just a couple of words about our guest speaker, Carolin, who we're really delighted to have with us today. Carolin is a Senior Lead Economist in the Fiscal Policies Division at the European Central Bank. Between 2021 and 2023, she worked at the bank's Climate Change Centre, where she was in charge of coordinating the economic analysis change-related work. And before that, she's worked in various divisions, including the EU Countries Division. Her research interests include climate economics, fiscal policy, and demographics. She holds a PhD in economics from the University of Cologne. Today, Carolin will explore the range of fiscal policies currently being implemented across Europe to mitigate climate change. She will highlight key opportunities and challenges related to climate policies, including in relation to the impact that climate change has on public finances. She will also touch on the implications of climate change for the European Central Bank. As I'm sure you will agree, this topic is highly relevant for New Zealand as we continue to refine our own climate change related policies, both with respect to adaptation and mitigation. So I'm very much looking forward to your presentation, Carolin, and I will hand over to you in just a moment. Just in terms of logistics, we are going to be using the Q&A function. Carolin will present for around about 45 minutes. Feel free to drop your questions into the Q&A during that time. And then after she has concluded the presentation, I'll moderate the discussion. That's all from me. Over to you, Carolin. Thank you.
Yeah, thank you very much for the nice introduction and also for being invited to this prestigious seminar. I'm really feel honored by this. So while I try to share my slides now, let me invite you to join me for the next 1.5 hours to the other side of the globe. So to Frankfurt. I hope you can see now my slides. At least we tested it before and it should work now. So I will speak now about the fiscal aspects of climate change, challenges and opportunities for Europe. And I would like to start my presentation by showing a chart on European summer temperatures and how this has developed over time. So the distribution of anomalies, how this has also developed over time. And you can see that the curve has shifted from starting in by the blue lines, which represent the 1980s, and the red ones. This is the current decade. It has shifted quite substantially. And also the distribution has become much wider. So compared to what we have experienced in the past. So this is clearly showing that climate change is no longer an issue of the distant future. But we can already measure it today, and there is. This itself is, of course, a concern. I mean, to have an increase in temperature, but then also we all know, or research by scientists show that an increase in temperature also comes along with an increase in extreme weather events. And this, of course, has huge fiscal implications, as I will touch upon in my slides. So just to bring this into comparison, where Europe stands in terms of global temperature. Indeed, if you look at the measurements by research institutes, one can clearly see that the increase in temperature in Europe is even above the global average. So something to worry about for Europe. Now, I wanted to give you a brief overview of what I'm going to talk about in my presentation. So I will start with some economic and fiscal impact coming from climate change and extreme weather events. Then I will focus on climate change policies that are currently in place or should be implemented within the next few years in the EU. I will also touch upon some challenges and opportunities for the green transition. And if there is still time, I will also speak about the relevance of climate change for the ECB and how we address it. Now, starting with the economic and fiscal impact from climate change. Here, let me start with with potential output. The table here illustrates how climate change is impacting potential output, which is, of course, a key variable that is also of interest for the ECB. So some of the impacts are clearly visible. So in particular, thinking here about the destruction of capital, if you think of buildings or infrastructure or so on. But there are also other factors which are less obvious, like the impact on labor supply. So, for example, due to extreme weather events, but also due to an increase in climate change, so in temperature, this is likely to have, to increase sickness or even increase mortality. There might be migration, and if you think about tourism, for example, there could be also a loss in education or human capital and skills that is needed. Now, the impact on the long-run impact of climate change has also some sectoral impact here, in particular agriculture and tourism, but also, of course, some regional impacts. So in terms of heat or a rise in the sea level. So for those countries that are at the seaside. investing in adaptation, that is maybe also one point that I would like to stress here when you look at total factor productivity. So while adaptation is of course important in order to contain the cost of extreme weather events, this also has some drawbacks in the sense that the money that is invested in adaptation, so building seawalls or air conditioning, I mean, could be invested much more. I mean, the money could be invested in innovation or in order to be growth enhancing. So this is kind of also an indirect cost of climate change, if you like. Now, another important variable, at least for, or in particular for us, at the ECB is, of course, also inflation. And here we also do see quite an impact coming from extreme weather events and an increase in temperature. So here this chart illustrates the impact of the summer heat wave in 2022 in terms of food price inflation. So on the left-hand side, you see that the marked with the dark red areas, that the impact in those areas which already have a higher level of temperature is larger as compared to areas which are cooler as a starting point. And in case you're not so familiar with the geographics in Europe, so what looks like a boot is Italy, and then also France and Spain are countries which are which have been more impacted by the heat wave in 2022 in terms of food price inflation than other parts. And this is the impact 12 months after the heat wave. Now, this analysis then also tries to project how such an increase or such an a heat wave and the impact on food prices would evolve if one then looks ahead into the year 2035 or even 2060. And so you can see that the heat wave in 2022 had an impact on food price inflation by 0.7 percentage points. Now, if we project that to the year 2035, the same increase in temperature would have an even higher impact. So under the pessimistic scenario of 1 percentage points and even 1.8 percentage points by 2060. And that shows the non-linearity which of the inflationary impact, given that then this heat wave would come on based on the average projected increase in temperature, which is underlying these calculations. So it's looking at the impact of the anomaly of such a heat wave impact on food prices. Now moving on to the fiscal angle, there are of course also on the public finance side important effects of extreme weather events and increasing climate change. These can be either direct or indirect, and the direct impact is mainly via the expenditure side. So here it relates mainly to public spending in order to replace or rebuild damaged infrastructure like bridges or streets or buildings. But it also relates to the materialization of explicit contingent liabilities. So in case there was a disaster-specific transfer to local governments or a public guarantee. There are also indirect effects, and they, on the expenditure side, relate to social spending in particular, in case there is an increase in inflation, in order to, for example, food inflation, in order to compensate, for example, vulnerable households. Or there could be also pressure on higher debt servicing costs, or also importantly, in case of an increase in temperature, this also can have impact on health spending. So at least in Europe, health spending is strongly related to the public sector. On the revenue side, there the impact is more indirect, as for example, in case of damages or an increase in declines or in productivity. This implies that then also the tax revenues will decline, or if there is a damage to property, then this also has some negative indirect implications for public finance. I wanted to show you a slide with the costs, the economic costs from natural hazards over time, starting in 1980 until 2024. And you can clearly see that these costs have increased over time. So they're divided into the part that is related to heat waves, wildfires, and droughts in blue, floods in yellow, and storms in red. And overall, if one adds all the costs from 1980 until today, this amounted to 822 billion euros. And in terms of economic losses, mostly related to damages to infrastructure and physical assets, so both on the private as well as on the public side. But what is even more worrisome is if you look at how this has developed in the last years. So only looking at the developments in this decade, so it's from 2021 until 24, the economic losses that were reported accounted for 25% of the total losses since 1980. So and that all measured in 2024 prices. So that's a tremendous increase in costs. So the trend is kind of worrisome. Also, if you look at the years with the highest cost, 4 of these is then in this century. So while this is not yet available under the European Environmental Agency, which publishes this cost for we also have some first estimates for 2025, and there it was calculated that for floods, drought, and heat wave, the costs were around 43 billion euros, which is 0.3% of GDP only in 1 year. One should also keep in mind, though, that while already this figure is worrisome, most of these natural hazards and disasters are very regional and that happen in or local, and where they have a disastrous impact, while if you then look at national level or here even at EU level, then this is kind of leveled off. So I mean, the figures look much more worrisome if you look at the at them at regional level as compared to averages, where then they seem to be small. So to cope with the impact of this disaster, fiscal support is required, and in particular in case there is not these economic losses are not insured. So potentially this is causing some pressure on public finances, and I will look and tell you more about the work that we did on the insurance side in order to underline the concerns that we have here. So one important aspect is, of course, also that the impact of these natural perils is expected to be non-linear. So there are tail risks, and an important element here is also, I mean, at what where is the threshold of resilience, and here again adaptation investment plays an important role, and I will come to this also later. But now, as mentioned, let me move on to the insurance coverage, which is quite important when thinking about the fiscal impact. So this is based on research done at the ECB together with EIOPA. EIOPA is also an European institution in charge of the insurance sector. And they looked at, first of all, the annual and economic losses, also how they are distributed across countries, and then to what extent these losses are covered by insurance, both at the European level but also at national level. And the result is that only 25% of the climate-related catastrophes have been insured in Europe. This figure is a bit better if you also take into account national insurance schemes, but still there's a huge insurance protection gap. And if you think ahead, and that with a further increase in temperature and further increase in natural hazards, that there are likely to be more frequent and intense events, and therefore economic losses, and so which is then making it potentially a challenge for with respect to the premium that needs to be paid in order to receive the insurance. And this then of course would imply that the insurance protection gap would widen, so something to really keep an eye on. And there is already anecdotal evidence for at least for the UK. I already read an article where there is indeed they see the rise in premiums as a risk factor also for financial stability. Okay, so now let me move to the climate change policies in the EU, and so where we stand, and what is further to be expected. So here, taking a look at the greenhouse gas emissions as compared to 1990 levels. we see that Europe had made quite some progress in reducing their greenhouse gas emissions. By 2023, the greenhouse gas emissions dropped by 37% as compared to 1990 levels. And this drop was mainly attributed to the shifts in the energy production. Now we have one intermediate. Our end target is net zero by 2050, like in many other countries that or areas that are committed to the Paris Agreement. But we also have an intermediate target, and that is to reach or to reduce greenhouse gas emissions by 55% by 2030. And the line or the dotted lines show you where we currently stand with respect to this target for 2030. So with all the measures that are currently in place, this target intermediate target would not be reached, let alone the net zero target by 2050. But even if all the additional measures that are envisaged were to be implemented, then even in this case, the 2030 target would be not met, although the difference is, at least according to even more recent estimates by the Commission, would be smaller than what you see here on the chart. Now, beyond 2030, the reason the net zero target will not be reached is of course that many more climate change policies would be needed in order to make that possible. And so the forecast currently is that by 2040 the reduction would be 62%, and by 2050 it would be 66%. So still a far way to go in order to reach net zero. The Commission, the European Commission, which is in charge of setting the climate targets and which makes the proposal, and then it needs to be agreed with the governments of the member states in the European Union. They recently suggested to have an intermediate target for 2040 at 90%. But then, of course, this also would imply that there were policies in place in order to make that a realistic target. And unfortunately, the political situation in many European countries is currently not very supportive of fierce or ambitious climate change policies. So this remains a problem. Now, looking at how climate change mitigation policies would impact public finances, also here there are various channels that are worth mentioning. So on the expenditure side, there are direct effects. So, first it relates to environmentally harmful subsidies. If they were reduced, this would have a positive impact on public finances. But at the same time, subsidies to support low carbon investment or even green public investment, they would of course, they are costly and they would have an impact on public finances and public debt developments. The same also is true for transfers to vulnerable households in case of carbon pricing having in order to alleviate the distributional impact, if this if a country decides to compensate that, this would also put a burden on public finances. On the revenue side, there are several instruments that have a direct impact, and I will come to this in more detail in a minute. So, of course, carbon taxes, but also revenues from the ETS 1 and 2, so the emission trading schemes that we have in place. At least we already have in place ETS 1, ETS 2 is coming. And then also an increase in tax revenues from low carbon activities, or a reduction in tax revenues, assuming that there would be restructuring away from fossil fuels. There is also, there are also indirect effects that matter here. So first to mention is in case the tax base could be impacted by redistribution of the economy, then at least in the short term, in case ambitious climate policies imply a decline in aggregate consumption, this could reduce VAT revenues, and also there could be a positive impact depending on whether climate change policies such as in public investment in green technologies, if this is implying an increase in productivity, this would of course have a positive impact on budget balance. Now, zooming in a bit on the climate policies that are relevant in the EU, maybe I've mentioned it. No, I don't think I have mentioned it. So the climate reduction target for 2030, this I had mentioned, is to reduce greenhouse gas emissions by 55%, and that is, as I said, an intermediate target, and that's where the name Fit for 55 comes from, because all these elements that you can, or policies that have been put in place under the Green Deal in 2019, they relate to the target to reduce greenhouse gas emissions by 55%. So otherwise, maybe the name is a bit unusual. So if we, let me briefly walk you through these main policies that have been adopted and that are still in, some of them at least are still in an implementary phase. So not all of this has been fully implemented. So to start with, on the left-hand side, upper left-hand side, the emission trading scheme. So we have ETS 1, and I will come to this in more detail on my next slide. But this is the emission trading scheme, which under the Green Deal target, Green Deal has been strengthened in terms of cutting free allowances and also broadening the coverage to additional sectors such as for example maritime. and this will be complemented then by a second emission trading scheme, which is called ETS2, which will come in place as of 2027, and that relates to the building and sector and road transport, so the emissions related there. So these are two separate schemes. They also, I mean, they have, of course, the same target to reduce emissions, but the way this is handled is different, and also I mean, ETS2 will also impact households directly through cars and housing. Another important policy that was implemented and which will be phased in as of next year is the Carbon Border Adjustment Mechanism, which sets a carbon tax for imported goods in order to avoid carbon leakage. And so this is closely related to the ETS1 and was being has in order to alleviate the pressure on energy intensive high emitting firms that are exporting firms. And then next, if we follow this clockwise, is the Social Climate Fund. This is a fund with an envelope of 65 billion euros for until 2032, if I remember correctly. And so that will be will include ETS revenues coming from the ETS system, and is mainly the purpose of this fund is mainly to compensate vulnerable households, but also to support green investment. And then the next policy area is the member states' emission reduction targets that have been agreed with the European Commission, and depending on their level, on the country's level of development and also their economic structure, and there have been, set nationally. Country-specific targets for all those sectors which are not covered by the ETS system, in order to also increase the ambition on these other sectors. So this also includes then, for example, agriculture, which is not covered by the ETS. And last but not least, then regulations. I mean, there are a number of regulations. You see here on the slide three mentioned, the most three important mentioned. Regarding the regulation that as of 2035, new cars should be emission-free. This is currently reopened the discussion. So this is, also due to pressure coming from countries like Germany. Then there is a target for in terms of the share of renewable energy, which that countries should have at least 45% of their energy production produced by renewables by 2030, and also the energy efficiency of buildings, be it private buildings, public buildings, or corporate buildings. There is a regulation setting some targets. Now, let me move more specifically on the ETS one system. So here, I mean, as I mentioned before, the ETS system and the carbon border adjustment mechanism, they have to be seen together. So what you can see here on the left-hand side are the various phases of the ETS system, which was founded in 2005. But at the beginning, this was, as you can see by the blue line, I mean, at some point the carbon price was close to zero. So this did not function very well in terms of setting a price for carbon emissions. So and the reason for this was that when the ETS system was set up, there were nearly all the emission allowances distributed for free. So there was hardly any trading scheme in place. This only developed a bit as of in the second phase, but then when the carbon price started to increase, and that also then led to some opposition by the energy-intensive industries, and so this eventually then, with the pressure increasing, led to the development of the carbon border adjustment mechanism. And that you see, I mean, the time plan for the phasing out of these free allowances is linked with the carbon border adjustment mechanism as shown on the right-hand side. So by 2034, there should be no free allowances any longer, and a carbon price will be implemented to imported prices, to imported goods. Sorry. Now, I think I'm running a bit out of time, so maybe very quickly, there has been a very interesting study by the IMF where they estimate the direct costs from CBAM. So I will not go into detail on this, but just I mean to mention that according to their estimates, the impact is relatively small. I mean, it's mainly related to electricity and iron and steel sector, but overall, in terms of GDP impact, it's relatively contained. So, and in case you're interested, there is also a hypothetical analysis on what the same carbon border adjustment mechanism implemented to Australia would imply for their trading partners, including New Zealand, and what cost this would imply. So maybe in the interest of time, I skip this analysis, which only shows, I mean, how a carbon price would impact inflation and GDP, depending on the variety of different macro models. An analysis we did a few years ago, and then because I would like to focus now on green investment, something which is important to bring the green transition forward. And there are a couple of estimates around in order to project what is needed in terms of additional annual investment to be in line with the Fit for 55 target. And these are quite amazing sums. So around 450 billion euros per year would be needed according to these estimates. And if you look at the chart on the right-hand side, you also see, which is based on the estimates by the European Commission, you see that the sector where most of the transition is needed is the transport sector. But when you look at what, in addition to what has been in the past, I mean, where the biggest improvement is needed, this relates to the to energy supply, which needs to double the amount of investment per year. Now, to support the green investment, public funds or the public sector plays, of course, an important role, because it, in order to de-risk private investment, besides also the direct public investment. And in order for the de-risking of private green investment, there as funds available at the EU level, and here in particular, the Recovery and Resilience Facility is playing a huge role. That is a facility which was implemented after the pandemic, and specifically has targets with respect to green, but also the digital investment. But there are also other funds. So in total, under the current budgetary cycle at EU level, which is usually for 7 years, and it ends in 2027. So the total amount is around 660 billion euros that is available in order to fund specifically green transition. Now, a pertinent question is to what extent this public funds will be sufficient to, if you compare that with the needs. And so we did this exercise, which is quite stylized, but just to see also the dynamics over time. And here, what we assume, based on the Commission figure for green investment, we broke it down by sectors, and then depending on what we could find in the literature and in terms of the public sector share, we calculated then a weighted average, so the public sector share here is around 17%. And that brings us to 83 billion euro per year that is needed for public green investment, which is the line here. And then this is compared to the available funding, and you can see that as of 2027, when the Recovery and Resilience Fund is no longer available, there will be quite a sizable gap, which needs to be filled somehow. Where, as I said, this is a very stylized exercise, but yeah, it speaks to the discussion we are currently having with the new budgetary cycle, which is coming up. Now, I will skip this in the interest of time, because it's quite obvious to what extent public investment is impacting the public debt. But just to mention, it depends also very much on what one assumes with respect to the response by monetary policy. Now, let me move to the opportunities and challenges for the green transition. And here I wanted to highlight a survey that has been done by the European Patents Office, where they have asked clean tech firms where they see the main obstacles for their business activities. And as you can see, the availability of finance, but also the availability of skilled staff has been seen as a huge obstacle for their business activities. But of course, there are also others, uncertainty about the future, energy costs, our regulation are also mentioned. So in case one wants to, or in order to promote green investment, I mean, this gives a good indication where to start. And then this is an overview of the holistic policy approach that is needed in order to foster green investment. So on the capital market sides, it is important to have better access to different types of funding and to foster the capital markets union and to allow for risk capital via venture capital. Then also to ensure that there are more long-term savings and investment products here, the pension funds that are available or play a big role, at least in some countries, are a possible area of where this could be linked more closely to green investment. Then there's structure. On the structure policy side, it is important to ensure that there is more favorable business conditions in order for firms to invest in the green transition. And here it's in particular the regulatory framework that plays a role also to reduce the burden, the reporting burden for firms, and to have a stable planning horizon. Patenting is also crucial, not only for green investment, but also because this is then used as collateral for financing. And of course, on the labor market, upskilling and reskilling should be a priority. When we look at the fiscal incentives and the provision of public goods, it's of course carbon pricing an important tool, but also policy certainty is crucial in order to foster investment. And as mentioned before, green subsidies are needed. When we think about what I showed before on the channels of climate change policies on the fiscal sectors, I also mentioned fossil fuel subsidies, and that is of course here an area to also point out again, because it also helps to improve the quality of public finance. Very quickly on adaptation. I mean, adaptation, the more adaptation investment you have, the better the more you can reduce economic costs of climate change. And that is, of course, relevant for fiscal policy in the sense that it might have a short-term fiscal burden, because I mean, adaptation usually is borne by the public sector, but then there are long-term benefits that then pay off in terms of lower economic losses that I've shown earlier. But of course, there is a limit, I mean, both on the fiscal side, but also on the technological side in how much you can reduce economic costs of climate change. And an important point, at least also in the discussion in Europe, is the distributional impact of carbon pricing. there is, some carbon inequality, if you want to call it that way, in the sense that the distribution or the carbon footprint here shown in depending on their income groups. So the highest income group here shown under 5 has the highest carbon footprint, while if you look at the consumption basket, the low income groups, their share of carbon high emitting products is higher as compared to other income groups. So there is a tension here, and this is even further increased if you think about that the carbon, with the ETS2, households will be will face even higher carbon prices for buildings and cars. So there are a couple of measures foreseen in order to alleviate that, and I already mentioned the social carbon fund that should help but there are also discussions to implement a carbon tax rebates for vulnerable groups. But this is a politically very sensitive issue, and well, we are not involved in that, but of course it's from a fiscal perspective, it's important that whatever is compensated, that this should be done in an efficient and targeted way. Now, quickly, on a positive note, although there is on the political side a lot of resistance to increase or to have more ambitious climate policies, at least EU citizens see the need to act, and they consider climate change being a serious problem. So 85% of EU citizens, based on a survey by the Commission, and 2/3 of the citizens also consider the national governments to be in the best position and to do something about climate change. So with this, I can maybe just very briefly mention why this is relevant for the ECB. So just to mention that, our primary objective is to maintain price stability. And that means to aim at a 2% inflation over the medium term. We also have a secondary objective, so that we should also support general economic policies in the EU. And both of these objectives are kind of supporting us in saying that addressing climate change or taking this as an important policy area is within our mandate. And so this chart only shows in a stylized way how price stability is impacted by climate change. So both with respect to climate change per se, and extreme weather events, but also looking at it from, if you look at the structural transformation, both are having an impact, a direct impact on inflation, but also indirectly via potential output or via the policy transmission channels. So therefore, we are monitoring this, the issue of climate change from various angles. And here's my last slide. and sorry for being a bit long. So this is on the ECB's climate path. Starting in 2015 with the Paris Agreement, since then we have implemented a couple of policies. A key point here was the strategy review in 2021, which led to the establishment of the Climate Change Center, but also a climate action plan for monetary policy, on which we have further worked, and now we are there has been a climate and nature plan where a number of projects and policy areas have been identified, and now the Climate Change Center is working on an update of this climate plan. So with this, I thank you for your attention and look forward to your questions.
Thank you so much, Carolin. That was a really excellent presentation, and so much thought-provoking and sobering material. And yes, you've generated a lot of questions. I suspect more than we'll be able to get through in the time. So we will follow a democratic process and prioritise the questions that have the most upvotes attached to them. So folks, feel free to vote for the questions you'd like to hear from. Just maybe one kicking off from me. Was really struck by one of your early charts that showed just the increasing economic losses being generated by weather-related events, and I thought it was a really helpful slide as you translated those costs in terms of the impact and the different channels on public finances. I just wondered if you could comment on those fiscal impacts in the context of the broader fiscal context, higher public debt levels, and the other pressures that are also coming on in terms of ageing, defence spending, and so on, and how governments are responding to those.
Yeah, thank you for your question. So I answer it one by one then. So indeed, this is a very topical question in the sense that this is a hot debate in Europe, and given that besides climate change policies, and there I mentioned that maybe the political appetite is unfortunately not as strong as it was a few years ago, but in addition to climate change, there are also, of course, other areas where a lot of public money is needed. And in the Draghi report, there is I think 10 or 12 chapters dedicated to areas where Europe needs to do much more in order to remain competitive and to I mean, to survive in a dramatic way. So, and then of course we have an aging population. We are now, as many of the European countries are NATO members, we need to increase defense expenditure. So there are a lot of public spending pressures that Europe is confronted with, while on the other hand we are still trying to digest all the fiscal support we have provided after the pandemic. So we still have relatively high debt levels, and in some countries, I mean, there is a strong need to clearly maintain fiscal.
I've just lost Carolin. Just bear with us. See if we can get her back. Just bear with us, folks. It looks like the issue might be at the Frankfurt end. Hopefully we'll be able to resolve this in a minute or two. Just to look through the questions and to vote for the ones you're most keen to hear from. We'll have Carolin back with us shortly. Sorry about the stall, Richard.
No,
oh, cool. So folks, we're still just struggling to get Carolin back on the line. I reckon we try for another minute or two. So yeah, encourage you to keep posting the questions, voting, and if we can't get her back within a couple of minutes, we'll call it a wrap. Fingers crossed. Yeah, just an email contact with Carolin should know whether it's possible to get her back on within a minute.
I'm very sorry. Can you hear me now?
We can.
I'm sorry. The connection was shut down, so I don't know what happened. It took me a while to reload.
Oh, good.
I'm sorry.
No, great to have you back. Yeah, glad that worked out. We can hear you loud and clear now. I think you were just wrapping up on that first question. Shall we go to the next one? This is a popular one come through from Tim, and one of your later slides sort of touched on this public support, and he wondered about what your impression is of the social license of ambitious climate mitigation action in Europe, and how that's changing as the global context evolves.
So this relates probably also to some large countries that are less keen on supporting climate change. Yeah, I mean, as I said, I think the support in Europe by some governments for climate change is not as strong as in the past, and that is of course also related to what is happening in other parts of the world. So either directly because countries are feel no longer committed to the Paris Agreement, or also indirectly because the economic situation is becoming a bit more demanding, and therefore this is seen as a kind of a luxury that we cannot maybe afford any longer, which is of course very short-sighted. Or myopic, but yeah, I think that is unfortunately currently the reality, that this is does not have this strong support any longer, and one can already see that with some responses by also the European Commission. They came out this week by making some concessions as regards the ETS2 system. So I mean, it seems that it is will be still implemented as of 2027, but there will be some I mean, some leeway or some policies implemented in order to ensure that the carbon price under the ETS2 will not increase as strongly as expected, but I mean, kind of a floor, that there would be a floor, or policies that ensure that there would be a floor for a bit longer. So in order not to provoke too much opposition.
I guess related to that in some ways, this is from Edward. He's asking, how is the ECB helping to link green investment needs with the broader goals of productivity and competitiveness, which the Draghi report highlight as central to the EU's future? And are there lessons for smaller economies like New Zealand?
Sorry, what was are there for smaller economies? What was the question there?
Lessons.
What
are we doing?
Yeah, so I think, well, I mean, the Draghi report also mentions, of course, the need for green investment. I mean, that is certainly also among the many areas or green investment where he points to the need to do more, and also highlights that this can be seen as an opportunity also for Europe and the European economy. So it's not only that it is costly, but I mean, if this is then leading to green innovation, then this can also help to spur growth. And so this is certainly an area which I mean, has some potential. I mean, maybe not all climate change policies are so growth friendly, but at least in the green tech area, I mean, this is I mean, there is certainly something coming. I mean, this needs to be taken seriously. And then, of course, there are, as mentioned before, there are many other areas and where more has to be done, and they are kind of competing given the budget constraints we are facing. So, and the countries have. I mean, to some extent, this is also. I mean, they have a target which is the same for all countries, but then how this is then in the end implemented in terms of the weights. I mean, that depends on their economic structures, the level of developments. I mean, some of the countries are still in a catching up process. And they maybe rely a lot on coal and energy. So I mean, there's Europe is very heterogeneous. So and that is then up to the countries also to implement the right policies for their countries.
Thank you. On a different theme now, this is a question from Tim. What drives the insurance protection gap in Europe? For instance, are insurers unwilling to offer insurance for flood risk in many cases? And if so, why is that?
Yeah, I mean, the insurance protection gap is, okay, no, there is no, or in most countries, the house owner is not forced to have an insurance against floods, and maybe and this has not been priced in certain areas well enough. So also now one area where the at least our supervisory angle is trying to also influence that is that I mean through banks and the requirements for I mean credit given to households or to house owners. I mean that this is now more closely monitored in to what extent then also climate risks are taken into account, and there maybe is the link also then with the insurance coverage, because I mean if this is seen as a risk which has a financial impact also in terms of the credit cost that you have to cover, because then maybe there are more incentives also to take up an insurance. On the other hand, I mean that's the demand side, but there are also problems on the supply side, and that is what I mentioned when I showed the slide, that with the increase in natural hazards. I mean, it is then also for the insurers, I mean, a very expensive area, and so they are already, I think one can already see that in certain areas. I mentioned the UK, but I think also in California for wildfires, I mean, that you can see that this is, the premium is going up so high that it is hardly affordable, and that there's so this would for sure then increase the insurance protection gap. This is at least the risk that we clearly see.
Thank you. Next question is around how you might think some of the fiscal tools in Europe might translate into a country like New Zealand, where we have an emissions trading scheme that covers almost all sectors with the exception of agriculture. Do you think there are lessons for us from Europe about how fiscal policy can support a transition without creating unfairness between sectors?
Oh, it is a difficult one. But yeah, well, I mean, I just had a look when I prepared this slide. So I think from the carbon price that you have with your emission trading scheme, it's a third of what we are currently having in the in Europe. So of course, I mean, there would be a huge jump if you were to move to I mean, within a short time to the price that we are currently facing. And then it's also a question of the sector coverage. So I don't know, probably for New Zealand, also the agriculture sector plays a much larger role. And there, this is, for example, not covered by the ETS system in Europe, and there are only, I mean, Denmark is currently considering to have a national carbon pricing scheme related to agriculture. I mean, this is something which is, I think, very difficult to implement when I listen to them. Yeah, so maybe that is not yeah, so straightforward as other sectors where you can clearly measure the emissions.
Thank you. A question from Christy. It looks like most of the models imply lower debt financing costs in the future. Is that climate related, or is that reflecting other factors like population demographics?
I'm not sure which models he was referring to. So I mean, I would not necessarily say that the financing costs are likely to decline. I mean, this is I mean, certainly if one thinks of the equilibrium interest rate, so R star. I mean, there are certainly demographics is playing a role for a decline in R star, but I mean, there are also many other factors, and climate is also playing there a role, but according to our analysis, I mean, this is there is no straightforward direction necessarily on how climate change is impacting our stars. So I mean, if you think about investment in green innovation, this is likely to have a positive impact. But then if you think about, I mean, climate disasters and damages, this is then impacting our story in the different directions. So I think there the jury, or okay, it's anyway not an observable variable, but I mean, there are certainly different forces at play.
Another question, and this is from Mario De Maio in New Zealand, about the Mario Draghi report, which proposed a radical plan for the energy market to lower prices, support market and grid integration, regulatory reform to support nuclear and renewable energy, and large increases to public and private investment. He's wondering, a couple of years on, does this direction still have any influence?
Does this direction has, sorry.
Does the Draghi report still have any influence in terms of those energy market proposals?
Well, with specifically on the energy market, I mean, that is probably, I'm not sure. I'm really the expert to make any judgment on that. I mean, in general, I would think that many of his proposals make a lot of sense. And well, in whether this okay, let's I think one problem is that I mean, in particular, politicians like to quote the Draghi report, but when it comes then to the policies to implement, then there is little action. So I think that applies to the energy market, but also to many other areas. So I think I cannot judge whether this will be relevant in the future. I think that there is that investment in energy markets is needed for sure. I think also in terms of making it a more uniform European market is a key. Is very important in order also to bring energy prices down, because that is, I mean, something where the industry is complaining a lot, and that I mean that limits their product. I mean makes them less competitive compared to other areas.
Thank you. And then just time for one more quick question. This is from Henry. And what barriers has the EU faced in cutting subsidies to carbon-intensive industries, and how has it managed to overcome those?
Well, I mean, we still have a lot of subsidies supporting in the carbon-intensive areas, and I think, unfortunately, I mean, with the energy crisis that we experienced 2-3 years ago, I mean, the support has for I mean, implicit subsidies, at least in some countries, have increased, and it takes quite some time to phase them out again. So I would say we have not gained a lot in the last years, and we need to be much better on this front. But then there are also, I mean, certain interest groups, let's put it that way, that are also hindering, I mean, to bring this forward. I mean, if you think about I mean, support for commuters, and then the discussion between the rural population versus the urban, and to what extent then you can politically really ensure that I mean, you have an increase in energy or oil, or I mean, that the cost of combustion, I mean, using combustion engines is considerably higher than what people in cities are supposed to pay for their transportation. Then, I mean, this is there is a lot of political tension, I would say. So this is certainly something to not easy to implement, but the IMF has a great data space where they show, I mean, clearly where countries stand with respect to their implicit and explicit subsidies, and I think for some European countries there is still quite some homework to be done.
Wonderful. Well, unfortunately, we've come to time, but just wanted to thank you again, Carolin, for such an excellent presentation, rich with insights, for your thoughtful responses to our questions as well. I know we'll all go away and ponder over some of the points that you've raised. And thank you too for giving up your evening for us. I know it's getting quite and Frankfurt. Folks, so we'll wrap there. Just a quick promo for our next seminar, which is a panel presentation on the 3 stewardship reports that the Treasury is releasing this year, as I mentioned earlier. We've got some wonderful experts on that panel, including Sarah Baddeley, Zoe Wallace, and Shimabeel Ekwap. The details for that will be released on our website and sent to subscribers very soon, and you'll be able to register for that session, which is in late November. On that note, I will close our seminar today. Thank you all for joining us with a karakia. Ki te kaha, ki te ora, ki te wairua, huie, taikia. Kia ora. Thank you.
Thank you very much. Have a good day. Bye-bye.